Can you hear me? Okay, apologies. Should be able to hear me now. Can you hear me, everybody? Let's see. All right, there we go. So as I was saying earlier on, so welcome to the stream again. So as I was saying earlier on, so let's kind of go back a little bit. So what I was saying was non-farm payrolls is the net amount of jobs that are created in the prior month. And you have two different surveys. You have the household survey, which is where the unemployment rate is derived from. And then you have the establishment survey, which is where the main figure, the non-farm payrolls figure itself, is derived from. And that is surveying 666,000 corporate and government work sites. Don't be put off by the number, okay? That's all they do. or a rough estimate, let's say. Then how does it affect the market? So the currency, as I was saying, it's usually a positive for the dollar. Of course, if there are more jobs that are being added to the economy, then there is the perception that the US economy is doing well or going to do much better in the future or continue to do well. And in turn, you have international investors and, of course, domestic investors and traders that will jump into the dollar and then buy it up, usually. For the stock market, within a non-tightening cycle, when the Federal Reserve is not hiking its interest rates or tightening monetary policy, it is usually better for the stock market. Of course, if there are more jobs that have been added to the economy, then there is a potential for more people to take up jobs, and then there's more spending in turn from the wages that they receive, and then to buy up the goods and services that are being provided within the economy. And also the productivity ticks up, and then hopefully that shows that the economy is in a stronger position potentially further down the line as well. But in a tightening cycle, when the Federal Reserve is trying to dampen pressures of inflation and make sure the economy doesn't overheat, if you do get stronger than expected jobs figures, then that leads to a depreciation within stocks. As you get the perception and the speculation and pricing in of the central bank maybe doing more with their tightening of monetary policy or raising rates by more or continuing to raise rates for longer than previously expected. For the bond market, bond yields usually see an uptick as well. Same reason as for the first one when we're talking about currencies. When you do get a better than expected jobs data, the bond yields or the bond market will react in a positive way when I'm talking about bond yields. For the bond prices, they see depreciation. So the reason why that happens is that when traders are, or when there is the expectation for the central bank to continue raising rates, and those bonds, their yields also rise as well in anticipation of further rate hikes or bigger rate hikes or more tightening by the central bank. The other reason why bond yields go up in a non-tightening environment is that if the economy is doing well, usually what traders and investors will do, more so investors, is they will take their money out of safe haven assets, such as bonds or government bonds, and then put it into riskier assets instead. So what the government does to try and attract those people or those investors is they raise the yield, or the yield rises and bond prices go lower in order to say, hey, yeah, we know the US economy is doing well, but how about you buy some of our debt too at the same time? Or maybe, maybe put all your money in our debt and you get a nice high yield in return. So that's why the bond market or bond yields would react in a positive way if you do get a better than expected jobs report, and vice versa if you get a negative report. Now, indicators are weighing on sentiment at the moment. So you have inflation, 3.2% compared to 3%. The PC price index, which will So yes, as I was, apologies for that, the sound kind of dipped out there. So I was saying, so PC price index, which we had this week, so it wouldn't be 3%, it's now at 3.3%. compared to the prior of 3%. You had GDP quarter on quarter, or the second estimate for GDP at 2.1% versus Q1's 2%. Unemployment was at 3.5 compared to 3.6. The ISM manufacturing employment was at 44.4 compared to 48.1. ISM manufacturing PMI was at 46.4 compared to 46. And the services employment data was at 50.7 compared to 53.1. Services PMI was at 52.7 compared to 53.9. And JOLTS job openings, what we had this week as well, was at 8.827 million compared to 9.582 million. Employment costs was at 1.2% compared to 1%. And ADP employment change was 177k versus 324k. So there's quite important things that we have to understand first with the JOLTS data and the ADP data. First of all, if you do get weaker data from JOLTS and ADP, usually the risky assets, such as your stock indexes, will see an appreciation. Gold would see an appreciation. Bond yields would see an appreciation. Would see an appreciation as well. But that's something I want to show you later on, and we do have a look at the market reactions as to what had happened with the ADP data in particular. Usually what traders do and investors do is they keep, or more so day traders, is they keep an eye on the ADP employment change figure, because they see that as a way to kind of predict what the non-farm payrolls figure could be like on the Friday. There isn't a strong correlation because the ADP employment data is looking at private data, whereas the non-farm payrolls figure is looking at not just the private sector but also looking at the governmental data as well. So there is no. Sometimes traders will think that, okay, if ADP was higher than expected, non-farm payrolls is also going to be higher than expected, but there hasn't been that clear correlation that marries up, or they marry up with each other. It's, again, as said, it's more of an indication of what could happen on the Friday, but there isn't that strong correlation. But what we're interested in is what was the reaction like from ADP. If data was better than expected, did the riskier assets or did the markets not like it or like it? And when I say that, I'm saying, did the dollar go up on better than expected data, and then you had the S&P tank or see depreciation, or did you see them moving in the same direction? That's how ADP should be used as a way to kind of gauge what direction the markets could go depending on what the non-farm payrolls figures are like. And it's also a way to indicate what is the sentiment like around the jobs market at the moment within the markets. Is positive data positive for the markets, or is positive data negative for the markets? So that's how we've kind of got to see it, and then again, as I said, it's quite useful in that regard, but not as a predictor of what non-farm payrolls could be. So the triggers then for the economic release. So non-farm payrolls, economists are looking at a high estimate of 230k with a deviation of 60k, and a low estimate of 130k and a deviation of about 40k. Unemployment rate with a high estimate of 3.6% and a low estimate of 3.4%. Average hourly earnings for a high estimate for 4.5% with a low estimate of 4.1%. Private payrolls with a high estimate of 200k and a low estimate of 100k. So this is we'll look at the deviations that we have on the Google Sheet, that if you have subscribed to the main list, you would have access to that already. So you'll see how big of a market reaction there has been depending on what the figures are like. That's quite important to understand how much of a reaction you're going to get out of the market depending on what the figure is. So more or less from what I had seen from the deviation sheet and how the markets have reacted before, it more or less is the same. There isn't too much of a deviation in the deviations that we're expecting, or that I'm expecting to see from the non-farm payrolls figures to what economists are looking at. Of course, they're doing the same thing, looking at how the markets reacted to reacted to data previously. All right, then the previous report in July, so you had notable job increases that occurred in healthcare, social assistance, financial activities, and wholesale trade. So healthcare, there was plus 63k, social assistance plus 24k, and financial activities of plus 19k. So one of the other things that we needed to, one of the things that we need to highlight is that the non-farm payrolls data expanding by 187k jobs, which falls short of the average monthly gain of 312,000 over the preceding year. Now that's an obvious thing, that the jobs market is going to cool down a little bit, but that's quite a significant cool down from what we've seen over the last preceding year. So what is the current estimate for today? So if the forecast is for it to cool down even further to 170k compared to the prior of 187, there is that chance that the data could be even lower depending on what the other figures are like as well. And if there are areas of where there might be bigger revisions that might have occurred in the past, and how then those revisions then might have an effect on the figure itself. And then Fed and government views, quite short again. So Fed's Bostic, the labour market is undergoing a measured cooling. Fed's Mester says we need to see moderation in the labour market and wage growth. Fed's Powell says lowering inflation also likely to require a softer labour markets as well. And Fed's Harker says I want to see softening in the labour market, noticeably in the service sector. And from the Fed minutes, you had participants that said the labour market was still very tight, although signs are emerging labour demand is in a better place. Then investment bank and research views. So you had UBS's Lipsey saying the equity market pullback in August was a healthy realignment, as sentiment had previously been overly optimistic about Fed policy and corporate earnings. That's quite an interesting thing to be aware of too. What's been said by UBS's Lipsey is, the way that I take it is that if the data, let's say, is stronger than expected, then that would disappoint the markets, because if markets are not expecting another hike from the Federal Reserve at the September meeting, but the non-farm payrolls data is stronger than expected, that could cause more volatility and in turn provide more of an opportunity within the markets if we're deviating from what the current sentiment is, what the current expectation is for the Federal Reserve. That then means that the day, if data is much stronger than expected, the day for the markets could be choppier, and you would experience more volatility if traders and investors are having to switch their positions or change their minds about the outlook for the Federal Reserve at their next meeting. Then carry on then. So from Goldman Sachs, they said that they estimate that US job growth needs to slow to around 75,000 per month to stabilize the unemployment rate over the medium term. And also the Federal Reserve, they wouldn't want continuous strong data coming out from the labor market. Otherwise, if that does happen, then that complicates the job for them. Let's say if inflation does go down, but the jobs market is still quite hot, the problem is that the job market could then fuel inflation if there are more people that have more spending available to them. And then it makes things worse, where then businesses might have to consider where they set their wages. Should they set them higher to kind of keep people, or to set them lower? Those are the other things that then complicate things for businesses themselves too. If the Federal Reserve is still, trying to tighten the economy to where they want it to be, and then leave it. Those are things that we have to consider. So revisions then. So the BLS released a prelim estimate for non-farm payrolls to be revised down by 306k in the prelim estimate. Now, what Moody's explained that the eventual benchmark changes released early, which will be released early next year, will impact the full period from April 2022 to March 2023. And they said, adding that the data was in line with expectations, that employment growth will be revised lower, and while monthly details are not yet known, the size of revisions would imply a 25k per month reduction in job growth. So why are we talking about it now if if the data isn't going to matter till later on? Well, it's the perception of what the market sees. So you have the economic release, you have the short-term market reaction, and then you have the long-term market reaction to consider as well. Okay, if let's say if non-farm payrolls was lower than expected, and you get a nice old run on the S&P, and gold sees a great move, and the dollar tanks. If those revisions start to show a deteriorating or a much weaker than expected US economy in the labor market in that area, then the sentiment could shift to where jobs data becomes, if good data is where it switches from going from good data is bad to good data is good. If the Federal Reserve also starts to switch their view that, okay, the jobs data that we've seen over the past year or so has actually been worse than what we would expect it to, or what we expected it to be. And then we might need to shift ourselves, or we might need to pivot sooner rather than later. Does that make sense? Hopefully it does. Got a couple of questions. Is ADP, Dragon says, is ADP presented to FinancialJuice website or only employment and NFP? Yes, it is. So that happened early in the week. ADP did. So yes, we have a whole set of economic releases, and this week's been quite a busy week of not just for the US releases, but we've had data with inflation data from the Eurozone, which actually caused a bit of a choppy mess within the Euro. Or I should say, not choppy, cause more volatility for the Euro. But yes, we do have not just non-farm payrolls, but ADP. All right, so let's look at the past reaction. We've got about 7 minutes. So this is one thing I want to talk about with ADP. Oops, it just kind of disappeared. So as I was saying, the figure, what we had was 177k. Now, one thing we need to just bear in mind is that from that data, which was worse than expected, not by that much, and then there's about a 20k deviation. The clear thing that, like I said earlier on, we need to understand how does the market react to the ADP data, and how will the market react then to the non-farm payrolls data. Well, it's not really too clear, but it is clear here that when you do get a weaker than expected jobs data in this tightening environment, with the Federal Reserve wanting to bring down those pressures of potential inflation and also an overheating jobs market or an overheating economy, in this instance, the dollar had seen a depreciation. The stock index, the S&P 500, had seen an appreciation, as did gold and bond prices too. So the yields went down off of the back of that data. So more or less, you could be expecting the same thing for the non-farm payrolls data too. And we'll look at let's go to the deviations. We'll just kind of show you guys. So let me bring that up here for you. Okay, let's get out of this. Right, here we go. Okay, so deviations on non-farm payrolls. Let's go across. Here we go. Now, the reason why, so one of the things that we need to understand is that we need to look for a good size in the deviation itself for the non-farm payrolls figures that we get. Otherwise, what can happen, what we had seen last time here, when non-farm didn't really have that much of a deviation, the markets were mixed. Okay, there wasn't a clear direction for the markets to take from the non-farm payrolls data. So that's what we don't want. We don't want the data to be muddled or there to be a little bit of a deviation here and there, because then it makes it harder to decide which way you want to go. Whereas, let's say that the data was, in the past where the data was bad overall, then it was kind of easier to see which way to kind of go. So what we've seen in the past where, as said, where data was weaker than expected, then you had seen the stock market or the stock indexes see an appreciation, and the dollar see a depreciation, as we can see here. So with the dollar, when you had seen worse than expected data, it was down 33 pips, and actually it has had the biggest market reaction in the currency space. That's another thing just to highlight. And if we're looking at the bond prices, the two-year bond futures, that has the biggest market reaction out of the bond market. Of course, that's the most sensitive to interest rates, so it usually has more volatility and bigger moves compared to the 30-year. But this is what we want to see here. So as said, with the deviations, if we're looking about around that 60k deviation, at least for the non-farm payrolls figure itself, what you'd also want to see, if you want to see, this is either way, okay, whether it's higher or lower, you'd want to see a 60k deviation, or about 40k for the non-farm payrolls figure itself. The other thing that you don't want to see is where the average hourly earnings, okay, again, another wage price pressure indicator, let's say in this instance, if wages continue to go higher, but the non-farm payrolls figure is much lower than expected, that could also muddle the picture. So what you'd want the average hourly earnings to also be heading down as well, with the non-farm payrolls figure and other bits of data too. If it doesn't, then you have a muddled picture. Vice versa, either way. So you'd want data going in one direction to get a stronger reaction from the markets. We got about a minute and a half left till we get the data. So let me just clarify that again very quickly. If data is going in one direction, it means the market reaction is clearer usually. But if data is muddled and mixed, then it means that the market reaction is going to be muddled and mixed itself, and it will take time for it to find its own direction. Okay, I'm going to get off of this now. So we've got the release coming up. Let's get our TICKSTRIKE up and ready. Okay, see what we get. So I think, as I said, just be careful of the average hourly earnings. If that does tick up higher, then that could muddle the picture, and it might mean that there's more volatility that creeps into the market. But again, of course, we're having to focus on all the bits of data. Okay, see what this baby does. Okay, 187k, 187k. That's high in the forecast of. That's high in the forecast of 170k. So again, non-farm payrolls 187k, high in the forecast of 170k. Unemployment rate at 3.8%, higher than the forecast of 3.5%, Average hourly earnings as expected of 4.3%. Canadian GDP quarter-on-quarter annualized at minus 0.2%. That's lower than the forecast of 1.2%. Private payrolls was higher than expected at 179k compared to 148k. Average work week hours 34.4, higher than the forecast at 34.3. Average early earnings month on month ticked down to 2% compared to lower than the forecast of 3%. Manufacturing payrolls was also higher than expected, and labor force participation was at 62.8% compared to 62.6%. Okay, so non-farm payrolls didn't get that 60k deviation. So again, and also if we're comparing it to the prior, remained unchanged. So not a strong report from the non-farm payrolls figure itself, but the stock indexes seeing a move towards the upside there of the S&P, as is the NQ. Dollar yen heading down, gold going up from that data there. Okay, so let's see what else we got here. Let's do some quick measurements. Let's see. Okay, so also keep an eye on Bitcoin too. We'll do that as well. 10 TICKSTRIKE to sensitivity level of 1. Probably won't even need that. It's going at it itself there. Right. Positive momentum there. Right. Measurement time. So again, not that much of a deviation. Did see an initial blip down, so I'm going to measure that first, and then I'll go back up. So about 40 ticks down, and then going to the wick of the candle. That's what I do with the deviations: is go to the wick of the candle to kind of capture the whole move that we had seen. Okay. All right. So 44 ticks up. I'll say what the dollar yen did. Okay. So there's a little blip. 10 or 11 pips towards the upside, and then okay, it's about 37 pips down off of the back of that. So measure of gold. Right, let's see which way the market wants to go. Yeah, so as I said earlier, the deviation wasn't that big from the data. So remember how we were saying to looking for if we're looking for about a 6k deviation, 46k deviation for non-farm payrolls data, didn't get that. So it was only 17k deviation. Okay. All right. Okay. Cool. Okay. Let's push that up. See what we got. Okay. See what we get. Okay. Still that buying momentum going. Okay. All right. Still looks like it wants to push up. Or maybe not. Okay. Right. So that concludes the live stream. So one of the things I want to do is talk about FinancialJuice. Of course, that's where we got the data from. That's where it appeared. And let me just move these out of the way. Get them there. Come on. There we are. So, FinancialJuice. It's a live voice and text service. Now, one of the things that if you have never come across a live voice and text service, first of all, it is there to tell you about the things that are going on within the markets, updating you with what's going on globally, what is the sentiment, what are central bankers saying, what are traders focusing on, and what is causing the market moves. That's one thing that we have to be aware with a live voice and text service. So that's what it does, is it keeps you informed, up to date with what's going on with the markets and what to kind of expect in what traders might be expecting. So here on the left hand, so again, live voice and text service in real time. We have your text headlines here. You have the live voice feature here with this little button. And on the left hand side here, you have the economic data as well. Again, all live in real time. So what is the key for a day trader is to be able to manage their risk and be able to capitalize on potential opportunities that the market might present to them. So in this case, if we're keeping an eye on the data, we might be You know, you want to be able to look at the data as quickly as you can, and this is the one place that you're going to be able to see that. Also with the live voice feature as well. Why else is it used? Okay, Fed swaps shift full pricing of a rate cut to May from June. Okay, so one thing, why use a live voice and text service? Well, the other reason to use a live voice and text service is because you have the big boys, the big investors, institutional investors, the banks, the investment banks that will use a live voice and text service, so they can manage their risk and capitalize on potential trades as well, and opportunities. That's the main reason as to why live voice and text service is used. Ooh, I need to. Okay. So what we want to do for you guys is to provide you with a 7-day free trial of FinancialJuice. And so you can have a little play with it, have an understanding of how a live voice and text service is used. But if you're not feeling ready to use the live voice and text service, then you still have the live version of FinancialJuice. And in the live version of FinancialJuice, again, there is a delay to the newsfeed as a whole with the voice, the text, and the economic data that comes out to the site, but it will give you an idea as to what a live voice and text service is like. Okay, and whether or not it's something that you can use yourselves to on your day trading. It is made for day traders. That's what it is. You're capitalizing on those opportunities that appear here and there, and managing your risk throughout the day. Talking about day trading, in particular, when we're looking at TICKSTRIKE, so TICKSTRIKE, what it does is it allows you to listen into order flow, okay, and see how much buying or selling momentum that there is within the markets. And one of the other things that we need to, one of the things for a day trader is that they need to be able to understand or be able to know how much buying or selling momentum that there is, and or another way to put it, how strong is the buying or selling momentum within the markets. And that's what TICKSTRIKE allows you to do. So if I pull up the S&P here, we'll bring the ES. Okay, here we go. So here on the S&P, what we're looking at here, this little ticker box, is we're seeing the buying and selling momentum. Okay, so the minus figure shows you the selling momentum, and then vice versa. So what we're looking at here is, and then you have this number here which says +1, said it could be -1. So this number represents the level of sensitivity of that ticker. So the level of sensitivity will basically, if another way to explain it is, 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling momentum that occurs, then TICKSTRIKE will pop off. And as it's doing now, it's giving you a visual. It can also give you an audio alert as well to what's going on. Now you can take that level of sensitivity and you can decrease it, and you can slide it on this little slider here all the way to 15. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs will TICKSTRIKE give you that visual and audio alert there. Okay. Now, one of the other interesting features, one of the new features that is here on TICKSTRIKE is the lightning bolt. What the heck is a lightning bolt? So with the lightning bolt, the lightning bolt is even more sensitive to the market reactions. Okay, so particularly if you're scalping the markets, right? What this does here, if I just put it to 1, so you have level 1, which is the most sensitive to market reactions. Okay, then with the lightning bolt, that takes it to another set of levels below 1, or from 1 to -15. Okay, and that basically means that the ticker is super sensitive to the buying and selling momentum that is going on within the markets. And of course, if you chop it from 1 to 15 with the lightning bolt on, that means you're going from 1 to -15, okay, with that lightning bolt on. So again, if you're scalping the markets, then again, it's another little perfect feature that you have another tool that you can add to your arsenal as well. So if you wanted, there's also a 7-day free trial of TICKSTRIKE as well to have a little play with and get used to. Or if you're not feeling ready yet, if I just bring up on the website, on the newsfeed here that we had here on the newsfeed, we have a free version of TICKSTRIKE. It's limited. You can't change the sensitivity of the ticker that you're looking at. But what you can do is, although you can still look at the S&P, the euro dollar, oil, and Bitcoin, and you can use that as a way to kind of practice how that might affect your, how you can implement that into your trading. And if it works for you, then great. If it doesn't, then that's also okay as well. Now, with the other things that we've got, so I'll take that off there. Otherwise, my ears are going to hurt. I don't want that to happen. So one of the other things that we've got to be aware of, or one of the things I should say I want to show you guys, is which is what I've already shown you, is the deviations for the economic releases. Okay, now how do you get your hands on those deviations? Now, like I said before, with the deviations that I've shown you, if you're subscribed to the MACROACE mailing list, you get access to the Google Sheet, so everything, including the Nonfarm Payrolls figure, and you can have a look at it all together in one place. On top of that, you get an email for the week ahead that will give you a small rundown of what to expect in the Europe, US, and Asia session. It's quite a short email, so it's not full chock-a-block of data, but it's used more as a summarizer and of what's happened over the weekend or on the Monday morning, and then you guys then you can kind of make your judgment from there. But you have your live stream links in there too, so let me go over that again. You have your deviations Google Sheet that's included, completely free, no charge. You don't have to pay for it. You have your mini rundown of what to expect for the week ahead and a summary of the weekend news, and also the live streams from the upcoming live streams that we have. All in one place, one email every Monday morning that's put out to you guys. So just kind of rein in any expectations that you might have. There might be charts and graphs. There aren't any of those. It's kept quite simple, because in the live streams is where I go through the detail with you guys and talk to you about it. Okay, that link is there in the chat is as well. As said, this will be the only live stream that we're doing this week. Though this was the only live stream we did this week for the economic releases that we had. But we also cover FOMC, the FOMC rate decision. We're going to be covering CPI pretty soon as well. So there are different economic releases that we cover. Sometimes you'll see on the deviations sheet, if I bring it up again, that there'll be some releases that haven't had their data updated. The reason being is because the market reactions haven't been that strong, or the importance has kind of withered away to the point where the market reaction or the release itself becomes non-important for your day trading experience. Still important for where the economy is headed, but in general, not enough to say, okay, this is a release you should be looking out for, sort of thing. So again, as said, we used to do EI inventories, kind of creeping back up a little bit now with its importance, but keep an eye on that. But yeah, as said, so there'll be different economic releases that we cover or have covered in the past, so you can have a look at all in one place on the Google Sheet. Now, usually when I do put out the week ahead email in the live streams, of course, those will be the releases that I'll be focusing on the most. and those will have the economic releases that are updated in the deviations. So let me just kind of make this kind of clear as to how this deviation sheet works and what does it mean. Okay, I can just say, yeah, this is free. You can look at how markets reacted, but how does it work? So this figure here, okay, which actually if I just pull up, if I go to a simpler one, so this figure here that I've just clicked on, this figure, well, this little part of it shows you the initial market reaction going to the wick of the candle, okay, and then the figure in the brackets represents the movement 10 minutes after the economic release. Okay, so usually if you see that there is, so this shows you that on the S&P it moved 30 ticks up, okay, and then 10 minutes later to where the candle ended, it was up 27 ticks from the economic release. Okay, so usually when you see this word saying up, if you see up or down in the initial market reaction, but you don't see it in the brackets, it usually means the market was going in the same direction. Unless where you've had some instances where you've had the market reaction where the market was, let's say, up. I'm just trying to find one here for you. Where you have the market reaction that was up, okay, we're looking at the 7th of July initially, and then 10 minutes after the release, it was down by, let's say in this example, it was down by 2 ticks. So that just shows you, again, as I said, if the word up or down isn't in the brackets, then it means that the market reaction is going the same way, or is still above is still above where it was from the release of the data. And if it has a word in there, that means that the direction has changed completely. It's gone below or above the it's gone below or above from the release data point. And one of the new things that I've added in, will be adding into the economic releases that I'll be doing from now on, is that I will also be adding in an additional bracket of 30 minutes from the market, from the release of the data. That will be included within the deviation sheet, because somebody did ask for it, as asking, well, what about 30 minutes, and then what about an hour? So we're going to go with 30 minutes, see how that kind of goes, get some feedback from you guys. See if you find it useful. If you don't, tell me why. But all feedback is welcome. Tell me what's not working. Tell me what is working. There'll be things to improve on for the service that we're providing here for you. So again, as I said, this is completely free. There's no charge to this, and I don't think there ever will be for these deviations. It's valuable data that you can use, and then you can use however you want to use it. Don't use this as a way to, I said, say, right, I know that the S&P is going to go 33 ticks down. You make your own assumption from how the data has reacted in the past, because sometimes it's not always going to be uniform. It's not always going to be verbatim or the same. All right, so that's the deviations there. Where's the S&P? Let's see, it's probably been... Okay. Right, so in the example here, so we'd seen that the initial market reaction, it ended, or the wick, or the last wick there was 44 ticks up, and then after about 10 minutes of trading, it was still up by about 38 ticks. So that's one example. Replay said, did you say the tick was delayed or just voice? If you're talking about, are you talking about FinancialJuice? So if you're on the live version of FinancialJuice, everything will be delayed. On the newsfeed, there will be a delay. But yeah, so that basically concludes MACROACE for the week. Thank you very much for joining me. Don't forget to like the video, subscribe to the channel, get the word out there. Vikas Pandey, yes. So provide the link there in the chat. So with the MACROACE link. Crazy to eccentric says, Tony, where did the unemployed unemployed number jump? Where did the employment number jump if jobs were created? Do you mean why the figure wasn't? I'm a little bit. Oh, you're talking about. So remember, this is representing the net amount of change that you're looking at. That so jobs were created, 187,000 net. A net amount of 187,000 jobs were created within the U.S. economy. I hope that makes sense. So of course, the total amount of jobs that there are within the economy, of course, that are being created, could be over the year will be way higher. Remember, this is just looking at the monthly net change of jobs that are created within the U.S. economy. Ooh, we had a bit of a discussion. Yeah, so I think some people might be confused. So I'll go over the deviations again. So the reason why the deviation, we're looking for about a 60k to 40k deviation, at least on the non-farm payrolls figure itself, is because because that's what the sentiment. That's how the market, from looking at past market reactions, the market had reacted to a similar figure in that way, to similar figures when the data was stronger than expected, or was bigger, or had a bigger deviation than expected. So that's why, if somebody had said, why did the S&P go up if the data was higher than expected? Well, it went up because the deviation wasn't that big. So if you're thinking about, so you've got to think about sentiment. Sentiment is that if jobs data continues to be much stronger than expected, then that means that the central bank will have to continue raising rates for longer. But this is what we've seen here. Fed swaps shift their full pricing or rate cut to May from June, so they're expecting the Federal Reserve to pivot sooner rather than later. Okay, originally they were expecting them to cut rates in July. Now they've gone from July all the way to May. So it could get to the point where they expect a rate cut in early 2024 instead from the Federal Reserve. Okay. All right, ladies and gents, thank you very much for joining me live for this stream. I hope you found it useful. Please do give me your comments and feedback in the chat. And actually, you can also send me an email as well at tony@financialjuice.com. There we go. To let me know what your thoughts are. Okay, thank you very much, ladies and gents, and I'll see you guys next time. Take care. Bye.